At some point you outgrow your pediatrician, and the same thing can happen with your financial advisor. Hey, I'm Wes Wood, the Income Guy and founder and president of Wood Financial Group. And for nearly 20 years, I've specialized in helping hardworking Tennesseans just like you reach their retirement goals through income-based financial strategies. And if you're looking for the right solutions to achieve your own financial goals, I can help. Just reach out to me at retiretv.com or by calling 615-826-5749 during today's show or at any time. We know that kids have health and medical needs that adults don't. That's why there are doctors who specialize in treating children. But the passage from childhood to adulthood isn't the only major change in your life. And the doctors aren't the only professionals who specialize. There are some financial advisors who specialize in serving income needs of people in or near retirement. And there's some advisors who don't. So how can you tell the difference? Well, I'm going to answer that question on today's show titled, How Come My Advisor Never Told Me That? I'm going to cover 4 things today. An non-income advisor specialist is probably not going to tell you, and the reasons why they're not going to tell you. The 4 questions to determine if you've outgrown your current advisor. And joining me on this week's show is Dave Scranton. Dave is an investing for income specialist with over 30 years of experience. He's also a best-selling author and a television host. But first, before we get to Dave, let's talk about the first 2 important things an advisor who doesn't specialize in retirement income probably won't tell you. Number 1, there is a major difference between individual bond and a bond mutual fund. The first one, the bond, is a conservative income strategy that comes with 2 important guarantees. One of them is a dollar amount of interest paid for the life of the bond, and the second is a repayment of the face amount when the bond matures, provided there's no defaults or bankruptcies. The second one, the bond mutual fund, not only lacks those 2 guarantees, but it also contains all the risks of a stock mutual fund. So why don't some advisors tell you this? There's 2 main reasons behind that: convenience and money. Bond mutual funds are convenient because once the advisor puts you in one, it's up to the fund manager of the fund to do most of the work. The advisor doesn't need to have a special expertise and resources to manage a portfolio of individual bond and bond-like instruments. And because he doesn't have them, he lets you believe the bonds and the bond funds are kind of the same thing. The other reason, again, not only convenience, but is money. Bond funds are simply potentially more of a lucrative option for the advisor who is not an income specialist. The second important thing some advisors won't tell you is that the stock market's well-known average rate of return of 10% over the long run is misleading. For one thing, just 7 to 8% of that return comes with price appreciation, while the rest comes from dividends. And more importantly, the average is based on decade-long cycles in which the market alternates between long stretches of 12 to 15% growth and then long stretches of no growth, 0%. And that's important to know as you enter into retirement. What if you're still invested for growth when you're 65 and the market suddenly enters a period of 0% growth? What would you have to do with your retirement goals? Would you have to scale those goals back or possibly even go back to work? And it happens to a lot of people, unfortunately. But why don't advisors tell you this? Well, I'm going to talk with Dave in just a moment more about that. But right now, you can learn more by reading my timely report, Why Investing in Mutual Funds Could Jeopardize Your Retirement. And it comes with your free retirement income kit, and you can get your kit by visiting retiretv.com or by calling 615-826-5749. Now let's welcome back David Scranton. He is the founder of Sound Income Strategies and the Retirement Income Store. Hey David, thank you for joining me again today.
Of course, Wes. So I had a laugh when I heard you talk about the pediatrician, because I was a guy as a teenager who was a weightlifter. I was a pretty big guy. But yet, even though I realized I had outgrown my pediatrician, I think it was probably age 20 before I finally moved on. So I think that's a great analogy to get people to realize that sometimes you outgrow professionals, and it's okay.
And I guess, Dave, that doesn't surprise me a lot about you. You stuck with your pediatrician maybe longer than you necessarily should have. Having a doctor or a financial advisor isn't just about liking the person. You may think the advisor is just the best person on the planet when it comes to helping you, but if you think about their business model and they're still focused on those growth years or the accumulation years, and that's their main focus, kind of like the pediatrician specializes in helping children, well, they may not be really well equipped to help you like a primary care physician would during your adult years. Just like a financial advisor that focuses on growth may not be as well suited when you're in that period of time where you're really needing to reduce risk, focus on income, and retire in a short amount of time.
And it's funny, when you talk about bond funds, I guess what you're saying is it's not just what your advisor tells you, but you also have to be careful of what he or she may not tell you also that you should know.
Yeah, that's right. A lot of advisors will use just mutual funds, right? They're using stock funds and bond funds. And yeah, it is true, and they know it too, that as you get closer to retirement, you need to reduce risk. But if it's just simply going from stock funds to bond funds, well, those bond funds may not be the best suited thing to reduce your risk. It could take a little bit of risk off the table, but it still doesn't have all the qualities of that individual bond like I talked about earlier. We'd much rather see people have a diversified mix of individual corporate bonds holding to maturity for the income portion of their portfolio. And reducing risk means going from that growth to those types of income instruments instead of using like a bond fund. Because what happens a lot of times is growth advisors can tend to muddy up the water, not on purpose particularly, not to try to mislead or to lie, but maybe saying that bond funds are just like buying individual bonds, which just isn't the case.
I can't wait to talk to you about the stock market, but we probably have to do that a little bit later on in the show. But the stock market is the perfect place where, it's not about just somebody telling you the truth. It's about the importance of their telling you the whole truth, as you intimated just a few minutes ago.
Yeah. And understanding the investments, educating clients is something that is obviously extremely important and sometimes doesn't really happen in our industry too much. But Dave, stay with us, and coming up after the break, coming up shortly, I want to talk about the two other important things some advisors won't tell you and why. I'm Wes Wood, the Income Guy, and you're watching the Retirement Income Show.
A fiduciary is someone legally obligated to act in your best interest. Doctors, lawyers, and some financial advisors are fiduciaries, but not all. When you work with Wes Wood and his team at Wood Financial Group, you are working with fiduciaries. They help clients create customized investment portfolios based off their retirement goals. If you're ready to work with a fiduciary, visit retiretv.com and schedule a free, no-obligation conversation with Wes or a Wood Financial Group advisor.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're age 55 or older, our free Retirement Income Kit is for you. Learn the fundamentals of investing for income. Discover potential hidden risks to your retirement plan. Visit yourincomekit.com to download your free Retirement Income Kit.
Hey, welcome back. I'm Wes Wood, the Income Guy, and today we're exploring the question, how come my advisor never told me that? So far, we've covered the difference between bonds and bond mutual funds and the truth about stock market growth cycles. Now, let's look at two other important things your advisor might not tell you, and if he isn't an income specialist. So, there's a common misconception that if you switch your financial strategy from growth to income, you can no longer invest in the stock market. And that's an uncomfortable notion for some people these days based on how well the markets have performed over the last 10 years. But the fact is that the performance of the market is largely driven by the unprecedented levels of the artificial stimulus pumped into the economy by the Federal Reserve. Ever since the financial crisis, the market has been more influenced by the Fed than economic fundamentals. That's another thing your advisor may not have told you. Probably because he knows after all this artificial tinkering that makes the market, that's going to make the market more uncertain. Therefore, more uncertain means more risky. And in many ways, that's how it is more than ever before. But he does know this, but doesn't want to tell you that that's what's going on. He also doesn't want you to know that there are ways to reduce your risk as you near retirement, that you don't have to abandon the stock market altogether. Certain income strategies that carry a bit more risk than the most conservative options, but they're also tied to stock market performance. And if you want to stay invested directly into the market, you can still do that, all the while carrying less risk than you currently have in your growth-based financial strategy. And as I've explained in other shows, one option is that you can invest in stock dividends rather than investing in stock capital gains. And this can be a much more practical way to stay in the stock market, in the game, after you're age 50 or so. Because after that age, you've kind of lost the luxury of time to make up for major market losses. Switching your focus from growth to dividends reduces that risk. And what's more, many studies have actually shown that dividend stocks outperform growth stocks over time. So how come your advisor won't tell you all this? Well, again, it could be because an actively managed, diversified portfolio of dividend-paying stocks takes a level of expertise that most advisors just simply don't possess. In other words, it's probably because that advisor is not an income specialist. Now, here's your chance to order my timely report, Investing in Income in the Stock Market. And it's free with your retirement income kit. And it's all yours by visiting retiretv.com or by giving our office a call at 615-826-5749. But now, let's welcome back income specialist Dave Scranton. Hey, Dave.
Yeah, it's funny. You talk about the Federal Reserve and what's happened that's unprecedented, all the printing of money and all. And I like to say that we're living in the age of economic uncertainty.
Yeah, that's true. I mean, with interest rates as low as they are, with the government the Federal Reserve just seeming to pump money into the markets, perhaps artificially increasing the price of stocks, there's a lot of uncertainty with the market. And with all that uncertainty, of course, carries more risk. So this is really the time for a lot of people, and I can't think of a better time than ever. The stock market continues hitting record highs, to really analyze the risk that somebody has in a portfolio to make sure it's appropriate for them with all this uncertainty and what's been going on.
It's interesting because the markets used to behave more rationally before this age, and a lot of advisors would like to make you think that they still do act rationally. But I want to get back to what you said before, where that's why we always say that in the stock market, a lot of times advisors will tell you the truth, but they won't tell you the whole truth. So elaborate on that if you don't mind.
Well, one of the things is that the notion that the stock market gives you a 10% rate of return. Well, that's
kind of true, right?
Yeah, well, to an extent, but again, it's just part of the story, not the whole story, right? There's actually, the market over the long term, some of that 10% has come from growth, about 7-8% of it, but then the difference has come from dividends. But the market doesn't wish it did, but it just doesn't make 10% year over year returns. Matter of fact, the market has these long periods where it gets stuck and literally makes 0% growth. And then there's years where the market goes up 12 to 15%. So you average everything out and it may be 10% rate of returns, but remember there's years that make no growth whatsoever. And for folks that are looking to retire and potentially entering into a phase where we're not going to get any growth out of the market for 10, 15, and in some cases 20 years, that's not going to be very good for their retirement at all if they're stuck in the growth world of investing.
And it's arguably the markets should have been flat from 2013 on for a bunch of years, but of course, the markets took off after 2013 because this unprecedented level of money printing by the Federal Reserve. So the good news, like you said, though, is if you still want to take advantage of that, if you said the government's still going to print money for a while, this isn't going to stop, the age of economic uncertainty continues, you can go from growth to income, stay in the market, but get your income, but without really having to give up the growth potential, which in many ways is like having your cake and eating it too for the right investor.
Yep, that's right. For the right investor that has the right risk tolerance, it can definitely be a good fit. Investing in the stock market for income can be a great solution to get some of that growth, but also get a good income off a dividend. I mean, I'm 41 years old. Really don't plan on retiring anytime soon. I've got a long ways to go. And if you looked at my own portfolio, a lot of my money is in those dividend-paying stocks. The reason why is that, I'm not necessarily a big believer the market's just going to go up year over year over year. There's going to be some dips, there's going to be some drops, major corrections. But even if that does happen, those dividend-paying stocks aren't going to get hit as hard. But also, as those dividends are being produced from those stocks, I can just take those dividends and reinvest it right back into those stocks when they're down in value. So it gives it a natural dollar cost averaging effect. And folks that are retired or close to retirement that are looking for income off of their portfolio, some of those dividend-paying stocks, they can collect the dividend even if the stock price goes down. In most cases, they're going to continue getting those dividend checks. But Dave, thank you again, and do stick around. And coming up after the break, I'll share some questions you can ask your advisor to determine whether or not you're working with an income specialist, or maybe if you've outgrown that advisor. Hey, I'm Wes Wood, the Income Guy, and you're watching the Retirement Income Show.
Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're age 55 or older, our free Retirement Income Kit is for you. Learn the fundamentals of investing for income. Discover potential hidden risks to your retirement plan. Visit yourincomekit.com to download your free Retirement Income Kit.
Hey, welcome back. I'm Wes Wood, the Income Guy, and thank you for tuning in to today's show titled, How Come My Advisor Never Told Me That? So far, we've talked about why some advisors don't talk about the difference between bonds and bond funds, and then the realities of the stock market history and what's going on in today's market, and stock strategies that are geared towards not growth, but income. Now, let's talk about some questions you might ask an advisor to determine if he or she is a true income specialist, or maybe you've outgrown your advisor. So the first question to ask your advisor: for a typical client at my stage of life, what percentage of my assets would you suggest I should have in common stocks or stock mutual funds versus income generating alternatives? Now, if that answer is higher than 40%, it's a sign that this advisor has a business model oriented towards portfolio growth rather than retirement income. The second question: what percentage of my assets do you tell your clients that they can take out annually from their portfolio while being reasonably confident that they will never run out of money? And the answer you want to hear is 4% or less. The third question: how do you generate enough interest and dividends from a client's portfolio to satisfy their income needs? And if your advisor gives you a blank stare or a long, awkward pause rather than a clear, knowledgeable explanation, That's a definite red flag. This advisor is probably one that you've outgrown now. Number 4, the last question. During each of the 2 major stock market drops since the year 2000, how did you respond to clients that called you in a panic? What did you tell your clients to calm their nerves? Now, this is actually a trick question. What you want is an advisor that tells you he didn't need to calm his clients because their portfolios were largely unaffected by those drops. You want him to tell you that he didn't have to talk to his clients about being panicked at all. They weren't panicked. Instead, they were relieved. They were relieved that they were invested for income because they knew that their strategies were specifically designed to protect them from a major market loss and generate a reliable income regardless of market conditions. And that's the answer you get from a true income specialist, the kind of advisor that will give you the straight scoop on bonds versus bond funds, about stock market history, about today's risks in the market, and the practical value of investing for dividends. The kind of advisor you need once you've outgrown your current advisor and are transitioning from the growth stage of financial planning to the income stage. But before I get back to Dave, I urge you to get a free copy of my report, 10 Signs You're Working with a True Income Specialist. It also comes with your free retirement income kit, and that's available to you by visiting retiretv.com or by calling 615-826-5749. But now, let's welcome back Dave. He's the founder of Retirement Income Store and Sound Income Strategies. Welcome back, Dave.
You know, Wes, I love the fact that you educate people about how to have conversations with their advisors, not just say, your advisor stinks, you need to come over to me, but to have these conversations. This concept about having them go with pointed questions to their advisor, I think is great, because it allows somebody to figure out for themselves whether that person is best suited to help them at a particular stage of life or maybe not.
Yeah, exactly. I mean, because many advisors out there specialize in growth. Some specialize like us in investing for income. And a lot of people that have hired an advisor really don't know the right questions to ask. So I hope with this show is to educate our watchers to ask those kind of right questions. Like ask, hey, what's your opinion about bonds versus bond funds? You know, what percentage of my money should be in the stock market that's invested for growth versus in more of the strategies that are invested for income? These are the kind of questions that really need to be asked to an advisor and interview an advisor. Even if you already have an advisor you've been working with, it's good to continue to ask those kind of questions. Just like if you were to visit a doctor and you had an ailment, or maybe you needed a specialist at this time, you want to make sure you ask the right questions. And even not only that, but perhaps get second opinions if you feel like they didn't answer those questions in the right way.
Yeah, the question about how to generate enough interest and dividends to satisfy income needs is, I think, all important, because so many advisors today with a 10-year government bond at 1.5% say, oh, that's all you can get is 1.5%. So I think that's the best question that they can go and truly ask their advisor they're with, or maybe one they're interviewing.
Yeah, that's a big one. I talk a lot about when somebody's taking income out of a portfolio for their needs. Maybe they need to take income out to satisfy a requirement of distribution. And we can actually show clients that in most cases, hey, we're generating enough in the form of interest and dividends to cover those distributions, whether it's a requirement of distribution or whether it's just income that they wish to take out of their portfolio. We can show them where they're generating enough eggs from those chickens. Now, oftentimes growth advisors really don't have a clue on how much interest and dividends those portfolios are generating. In a lot of cases, they're just liquidating shares of these growth investments to give distributions to their clients. And liquidating shares in a growth portfolio to supplement income retirement can be really bad for the client. And the reason why a lot of people are getting this advice and they're going with that is because they haven't really gotten to know whether or not their advisor is a growth-oriented advisor or an income-oriented advisor.
Yeah, and you could tell because those advisors tend to talk about growth and return synonymously, as if growth and return are equal. They totally forget about the income component, which is a very important part of return over the long run.
That's right. I mean, if you want to make returns on your money, it's a simple equation in the financial industry. The equation is total return, TR, equals I, investing for income, plus G, investing for growth. Two different ways to get a return. One way is focusing on capital appreciation. One way is focusing on interest and dividends investments. And really, it's kind of two different worlds. And in our industry, so many folks just focus on the G instead of the I to get a return for their client. And they kind of combine those things together. But yeah, Dave, great questions for me today. Always enjoy seeing you. And thank you for joining us. But I'm Wes Wood, the Income Guy. I want to say thank you for watching. And if you have any questions about anything we've covered on today's show, please reach out to me at retiretv.com or by calling 615-826-5749.
Retirement accounts like 401ks and IRAs are great tools to save for retirement. They offer tax advantages to help keep more money in your pocket. But withdrawing money from your accounts can have a huge impact on your tax liability. Take money from the right account at the right time and you could minimize it. But taking money from the wrong account at the wrong time could result in a big tax burden. If you're not sure what you should do with your 401k in retirement, visit retiretv.com to schedule a free, no-obligation conversation with Wes Wood and Wood Financial Group.
I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're age 55 or older, our free Retirement Income Kit is for you. Learn the fundamentals of investing for income. Discover potential hidden risks to your retirement plan. Visit yourincomekit.com to download your free Retirement Income Kit.